What is going on, Benzinga Nation? We're so excited to have you here because there's so many different ways to kind of up your game when it comes to your trading, right? There are a lot of different instruments, a lot of different vehicles, but today we're going to go ahead and talk about leveraged ETFs. It's another way when you know you're confident in position, this is an opportunity for you to maximize your gains and of course, in a healthy manner as well. But look, I'm not going to be the one to kind of break this down for you. We've got someone who's got a better name than me, a better hairstyle than me, and a lot more knowledge when it comes to trading these ETFs. Let me go and bring on my man Gianni to the show. What's going on?
Junaid, how you doing? Thanks for having me.
I feel like that's the best compliment or a series of compliments that I can give you. But I'm really looking forward to what you and Eliott have to kind of educate us on the best way to use these leverage ETFs.
I'm looking forward to it as well. And, there's some good way to capture some big gains in short periods of time with these products. So I'm excited to talk about them.
Awesome. We'll tell you what, the show is yours. I'll be in the back and looking forward to the conversation.
All right. Okay, let's see. We got to share the screen here, I think. There we go. Oh, there's Eliott.
Hey, here we are. Good morning.
How's it going, Eliott?
Good. Happy, I almost said Wednesday. Happy Tuesday. I'm dreaming right now.
Not quite there yet, but we will be soon.
Yeah, exactly.
Well, I'm glad to be here, and thanks for being a part of this. I've been working with Direxion products for several years, and I find them to be pretty good short-term trading instruments, and I just love the variety of sectors that you're able to trade with, and not just the sectors, but a major innovation that's come around in the last, has it been about a year, I think, the individual leveraged stocks, which I find pretty fascinating for those that want to take on leveraged with some of the biggest tech stocks in the market without necessarily trading options. It's a really unique and innovative product. So we can go ahead and get started, but I think you have some housekeeping matters to begin with, just with some of Direxion's background at the beginning of this today.
Yeah, no, of course. And just to introduce myself, my name is Eliott Wellenbach. I'm with Direxion, have worked with Direxion for about 6.5 years now, focusing on our institutional clients. And just to give you a little, the viewers, a little, understanding of who Direxion is, if you're unfamiliar with, the firm or even our funds, is and of course, this is a fun disclosure slide. It wouldn't be any financial presentation without having that. I won't make the viewers read that, and I won't read it off myself. But just a quick background on Direxion. We've been around since 1997. And on the next slide, you'll see our assets right now are about 42 billion in assets under management. And we really specialize in fairly unique ETF and kind of niche products. We're definitely more of a boutique manager. We specialize in what many traders know us for, our leverage and inverse ETFs, but we also do have some strategic and thematic ETFs. And just to give kind of a background on the leverage and inverse landscape on the next slide, you'll see that there are now over 234 leverage and inverse ETFs in the marketplace, and about 100 billion in assets under management. That's including some of the other players. And on this graph, you can see that I'd say a lot of traders tend to be a little bit more bullish. These products are used for short-term trading on the bearish side too, but the assets across the leverage and inverse landscape are heavily skewed towards the 3x bull side of the products, and understandably so. Traders like the movement, and there's a lot of bulls out there. But if you're a bear, don't worry. There's plenty of products out there for you as well. And just to give on the next slide, just kind of an overview of leverage and inverse, and really, what these products are, is they're very different than your traditional ETF. These are intended as short-term tactical trading products. So we offer leveraged or inverse ETFs, anywhere from single inverse for hedging all the way up to 2x, 3x bull or bear products. So leverage or inverse products that provide a magnified daily exposure. And I say daily, that's very important. And I'll get into that in a moment. But essentially, for every $1 invested on a daily, you get daily 2x or 3x exposure, depending upon if you're in a 3x or 2x fund. And I won't get into the boring details of how we create these, but we typically use swaps and sometimes futures contracts to obtain that enhanced exposure. But why am I telling you all this? We want to make sure that any trader with these products understands how these work. That's very important. So just on the next slide, this is a quick overview of kind of how a leverage ETF worked. And I mentioned earlier about daily and why that's important. That's because every leveraged ETF, all of ours, including any ETF that is out there that you can trade, has to rebalance its exposure daily. And by rebalancing the exposure daily, I mean at the end of every trading day, we're going to make sure that you start out tomorrow with whatever targeted exposure that is, whether it's 2x, 3x, inverse 2x, inverse 3x. But that's a very important thing, because with leverage and with the daily rebalance, you can see, you should not expect to see, let's just say hypothetically, the S&P is up, 5% over the course of a year. You shouldn't just expect to see, a leverage bull product 3x on that to be up 15%. And that's very important for traders to know. And also that these are intended for short-term tactical trading. So really understanding these, and I won't go through all this, all these charts, but essentially just a quick high-level overview is, you start with an initial investment of $100. That means that you in a 3x bull product, that means you have $300 worth of exposure. So let's just say the ETF, let's just call it, make it easy, S&P 500 SPXL 3x bull on the S&P, our product, that moves up 15% in a single day. So at the end of the day, your $100 has turned to $115. But at the end of the day, we need to go out and rebalance the fund. If we didn't rebalance the fund, you would have only $315 of exposure. Like I mentioned, you have to start out every trading day with a 3x exposure. So your new exposure is going to be $345. So again, I'll go to the next slide, which will make a little bit more sense, of kind of what I'm talking about. This is a example of, you see the underlying benchmark and then a 3x bull product off of that and a 3x bear product off of the same benchmark. And it's going to sound really corny, but it's very true with these products that trend is your friend. The stronger the trend, the better over that trading period. So this is a great example of a multiple day, I think it's about 5 or 6 trading day, overall trending, market for that benchmark. So the underlying is up 11%, a little over 11%. The 3x bull fund is up a little bit more than a 3x return of that. And that's because you can see that overall trend line in the benchmark. The bear fund is actually down a little bit less than, a 3x cumulative return of that benchmark. And that's because, again, in that scenario, the daily rebalance actually helps you as you're reducing, your overall exposure as that market continues to trend down. That's the best case scenario, but we'll go to the next slide and show you what can happen, pretty regularly with leverage and inverse ETFs. This is what we like to call a highly volatile whipsaw market environment, where you have the benchmark, over, a few days or any span is, there's a lot of volatility, large moves to the upside and also the downside. And overall, the benchmark's ending relatively flat. And so you see that your bull ETF is not up 3x of that cumulative return of that benchmark, and the bear fund is actually down more than 3x. So this is just meant to highlight that the daily rebalance with these funds is really important, and understanding that these are short-term tactical trading tools is also very important. They are not buy and hold investments. They're great trading tools, but we want to make sure that anybody that's considering or is trading these products just understands how these work, So, they can have the best experience while using them and possible. And just, quickly on the next slide, I mentioned how are these funds actually used? Short-term opportunistic trading. We have a lot of investment professionals. I work with our institutional clients, hedge funds, family offices, tactical RIAs. A lot of them use technical indicators, whether signals to trade in and out. Hedging more for the single inverse side. Portable alpha, meaning that you really can, if you're looking to put a certain amount of money shorter term in, say, the S&P 500 or a sector specific, exposure, you can put less capital down to get that exposure for short term and free that up to put that somewhere else, diversify, or, trading somewhere else. So again, these are very, strong and powerful tools that, are used by traders. But again, want to make sure that everybody's, familiar with, how they work. And, I'll kind of stop there on the education side of everything. And Johnny, I'm not sure if we want to hop into some, examples, or, happy to, highlight a couple of our other product suites as well.
Well, let's start off with what you have on the product suite, and I can discuss those because these are all products I'm pretty intimately familiar with. So, and I can talk about what's kind of happening in that space. So,
yeah, absolutely. On the next slide, one of the biggest, kind of actually mentions right now with the technology select sectors. So we saw that rebalance that took place that was effective, this Monday, where NVIDIA, traditionally in this, in the technology select sector, Apple and Microsoft have been the two heavyweights in there, both, in the middle to, sometime, mid 20s, low 20s as, the two largest exposure. And NVIDIA was actually a very, was very underweighted in that, relative to Apple and Microsoft. This is not updated. I apologize. This is not updated. What you see on the page right now, as it says, Apple is 19%. As effective as of this past Monday. Now, Microsoft and NVIDIA are both about 21%, and Apple has been bumped down to 4.5%. And that's really, we've seen that because of the rise in the market cap and the trading of NVIDIA, so it's definitely been an interesting space and a lot of trading around that, and a lot of, honestly, general just news around that as well. And the products that we have there for trading are TECL, that's the 3X bull fund off of the technology select sector, and then TECS, which is the 3X bear fund. And we kind of saw tech overbought last week, and that's kind of what helped push the market lower overall in some of those larger names. We've seen NVIDIA retreating this week. So it's been a pretty exciting space. But Johnny, one thing that on slide 14 that you mentioned, kind of some innovation, the single stocks, wanted to definitely highlight those. So as Johnny mentioned, our single stock ETFs are coming up on just about a year of being out in the marketplace. We were one of the first to move, make the decision to provide leveraged single stock exposure. So you can see we have all of the Magnificent Seven and their 2X exposure. And then we also have on the inverse side, we've seen a lot more of the single inverse used for hedging. But these are kind of newer to the leverage inverse space over the past about year. Definitely a very exciting space. For Direxion's ETF suite, we've seen 3 of these funds be in the top 10 inflows across all of our about 90 products. Out of all 90, 3 of the funds, TSLL, which is a Tesla bull product, NVDU is the NVIDIA bull product, and AAPU, the Apple 2X bull product, all 2X, are in the top 10 of our entire inflows this year. So a lot of interest coming from both retail and institutional investors and traders for short-term magnify exposure to the single stock names, especially around NVIDIA this past year.
So I'm actually planning on giving an in-depth breakdown of all these companies and their technical setups later on in this presentation. But I do want to back up a little bit and go back to that technology slide, because I do want to elaborate on the significance of the tech sector, because it is by far and away the largest sector in the S&P 500. Technology has a tendency to act as a leading indicator with respect to index performance. Now, what does that mean? Well, assuming that, let's say you're in a bear market, chances are, according to history, that coming out of that low, tech will bottom before the index does and outperform to the upside. But let's say you're in the late stages of a bull market. Chances are tech is going to peak before the rest of the market and start to roll over. So with this type of fund, you kind of have an opportunity to take a leveraged short-term bet. And as Eliott mentioned, we did see some selling in the tech space last week after it continues to outperform the rest of the market, which is a good sign overall. But, shorter term, if you're, long individual tech stocks or long the tech sector through, other traditional, non-leveraged ETFs, these types of funds like TECS gives you an opportunity to hedge near-term exacerbated moves, so to speak. So, you had a big breakout in the NASDAQ. Technology was leading the market higher. Everybody knows what's happening in NVIDIA. And it's not just NVIDIA, as I'll show you later on in this presentation, but this gives you short-term hedging opportunities. And I also do want to comment on one other thing, Eliott. This happened about a month ago, right around the Memorial Day holiday. We switched the trade settlements in equity products to 1 day. So it's never been easier to trade these types of leveraged funds, because once upon a time, when I started in the business, seems like a lifetime ago, you had to wait 3 days for these for any equity trade to settle. So the industry's evolved, and it's becoming more accommodative for short-term speculators. And if you, like I said before, if you don't want to trade options, this is a really good type of product for you to take leveraged concentrated bets on individual stocks and sectors. So that's my take on tech. It's an excellent leading indicator. And if you have a hunch that a broader market pull down or a drawdown is coming, keep an eye on the the short-term bear tech sector, because a lot of times you'll see the first move lower in technology.
Yes, no, definitely. It's like you mentioned, great short-term trading products. Really a great way to take advantage of those moves at a leverage exposure. And as you mentioned, if you're not looking to trade options, have a margin account. These are some of the easiest ways to get through these products short-term leverage exposure. And with especially what you mentioned now being T+1 across the equity space. It's never been easier to trade these products.
And I see in the next slide, we have treasuries to discuss as well. And I know bonds aren't exactly the sexiest asset class to talk about, but I like bonds. I think bonds tell us a really profound story about what's happening in the market, and some really interesting stuff happening in the fixed income space over the last 9 months or so. Bonds were in a secular bull market for 40 plus years, but then we had the all-time high in bond prices registered during the COVID crash of 2020. But ever since March, April of 2020, bonds have been in a generally bear trend. And it is kind of interesting to me to see that despite all the bearish price action that we've seen in bonds, how much larger the triple leverage bull fund is with respect to AUM compared to the bear fund. But that's, part of the rebalancing process, obviously. And, I'm not saying it's going to go back to parity between the two funds, but, there's obviously, you're unwinding a 40-year bull market. It's not going to happen in 2 years, right? But what I'm saying here, and what I want to, really elaborate on when it comes to treasuries, is that we've seen a general bounce in bonds since October of last year, and the price action in the bond space has really been range bound. So it's been a really good opportunity for those to buy support from a technical standpoint and to sell resistance. And basically, if you're buying support, you want to be long TMF. If you're selling resistance, according to the prices, you want to be buying TMV. So keep an eye on these, because we've had some pretty volatile price action in the bond market space over the last several months. And again, the only other way to really get leveraged bond exposure is to trade futures, really. And that might not be the first stop for many getting into the game. Otherwise, you're just trading 1x, and there's not that type of volatility in price movement to make significant gains. So I like bonds. I think they tell a big story about the economy. Inflation is slowing down. It has been slowing down over the last several months, so that explains the rebound in TMF. It's generally trended higher over the last few months, but when it comes to TMV, you zoom out. As I like to say, when in doubt, zoom out. You look at the last couple of years. Eliott mentioned the trend is your friend. That's important, because generally the greater magnitude of price moves happen in the direction of the underlying trend. So again, it's contextual. Know your time horizon. These are short terms, but if you look at the longer term trend over the last couple of years compared to the last few months, you saw bigger swings, directional swings in TMV versus TMF. But over the last few months, it's been more in TMF. So you need to keep an eye on those inflation numbers, even the employment numbers. As long as inflation stays contained, I think you might see some, greater moves in TMF, the bond 3, the bull 3X shares. But you start to see inflation tick up again. I think that TMV will be the easier trade for bigger moves. And then with respect to employment, you get an uptick in employment. Believe it or not, that might actually help TMF, the bull side of bonds. But if the economy stays resilient and unemployment stays contained, then I think there'll be more opportunities in the TMV side of the market. So that's the beauty of these. There's always a trade to be had, and you just have to stay on top of what's happening in the overall market.
Yeah, no, definitely. Like you mentioned, of the difference in assets, with the bull fund, being significantly larger.
Yeah.
TMF we've seen is actually the largest inflows we've seen this year across our entire suite. And like you mentioned, it's contrarians, taking the other side of where actually the interest rates and treasuries are going, trying to see that short-term bounce, which overall, like you mentioned, this year we've seen pockets of it, but we haven't seen it yet. And we see a lot of trading pickup around any inflation reports. We have the PCE this Friday. That's kind of the next big report to come out. But we've still seen, most Fed officials saying still not appropriate to lower rates. I think I remember back in the beginning of the year, I think it was about 75% confidence, baked into the Fed fund futures that there were going to be 2 rate cuts by, the June meeting.
Yeah.
Fed.
Here we are.
Yeah, here we are. No rate cuts, and now Fed fund futures is pricing in maybe 2 by the end of the year. So inflation definitely, like you mentioned, it has come down, but it's remained much stickier than anticipated by a lot of traders and investors. So these are great trading tools around any Fed meeting, any inflation jobs numbers that can really move treasuries. So great trading products around that.
I do want to add one more thing, because like I said, I am kind of a bond nerd, and a lot of traders, they talk options, they talk stocks, but I do enjoy trading bonds. With respect to inflation, the Fed's traditional definition of price stability is 2% annual inflation. So we're still above there. And again, just keep in mind what that might mean for funds like these. If we're still running above 2% annual inflation, is the Fed going to cut rates? So that might give you more of an opportunity on the Treasury bear side. But obviously inflation expectations can change. So that's a key annual level that I would keep an eye on with respect to inflation data, is that 2% mark. And of course they can change that, but that's been the traditional, price stability definition.
Yep. One last thing I'll say about these is they're a little counterintuitive. So if if you are a trader thinking that, rates are going to remain higher, and so these are based off of the price, not the yield.
Right.
So if you think yields are going to continue to remain higher, you actually take the bear side. So a little counterintuitive, but that's how bond works. If you're thinking that rates are, if there's some price in action, that rates are going to start dropping, and then you take the bull side. So great trading tools.
Let's move on to the S&P 500 because that's on the next slide. And obviously everyone's looking for a top to short. And remember, talking about bull trends, how the greater magnitude of price moves will be in the direction of the underlying trend. So that means you'll probably see bigger moves in SPXL versus SPXS as long as the bull market remains intact. And we were just talking about bonds, and there's a really good way to measure liquidity through bonds, and it's through spreads between treasuries and corporate debt. I'm not going to get into that too much, but basically, if you ever start to see spreads widen, it usually means liquidity conditions are deteriorating, and that opens the door for short, sharp moves lower in stocks. And in that situation, SPXS is the trade that you're going to want in that environment where liquidity is drying up, spreads are widening. Obviously you're near the highs. We're near the highs now. I still think we can go higher overall in this equity bull market, but I'm not leaving the door shut with respect to the potential for some volatility at some point this year. And aside from 2022, where we had a bull market lasting a bear market, lasting several months. A lot of the bear markets or cyclical downturns we've seen in stocks over the last really decade plus from now, in retrospect, have not lasted that long. And they've been characterized by very sharp moves, quick moves lower. And, these are products that can help you hedge, if you have a core equity position in your portfolio and you don't want to, buy puts or sell calls to hedge through options. You can always pick up a short position in SPXX to help protect your core long holdings. And again, it's leverage too. So you don't need to have a huge position to make quite a big difference on your portfolio's underlying value.
Yeah, no, definitely. Like you mentioned, 30 all-time highs this year so far. That was as of last week, so I haven't checked. I don't think we've definitely traded intraday, but we haven't closed, at another one yet. But as you mentioned, there's this rally we've seen this year. We're seeing fewer and fewer stocks really contributing to that rally. It's been very much weighted on those top, quartile of the top weightings and top technology names that, as you mentioned earlier in the technology select sector, have really been, leading this market higher. But we're still seeing some pretty strong numbers coming out of it. So, I agree with you. We'll see if we see another all-time high. But SPXS, great way. I mentioned that portable alpha, which you just brought up, as well as you get the magnified exposure, and you're able to hedge some of that exposure you might have in your current portfolio. Also when it comes to more of capital gains, if you're looking to take off exposure and in your taxable account, you might not want to pay some long-term capital gains on some of your equity exposure, especially in the S&P. These are great ways to short-term hedge that instead of realizing that in a taxable account as well.
Yeah, that's great. And then let's see, and then we have the individual stocks, which I'm going to talk about. But if you want to touch on some of the educational resources before I get into my my diatribe here, Eliott.
Yeah, no, definitely. I would just say, all of our, we have a great educational section on our website at Direxion.com. And I mentioned the beginning of this and, why I kind of went to depth of how our ETFs work and the daily rebalances. We want to make sure, traders understand how these tools work. They're very powerful. They're very strong tools. and they're great used correctly. And we want to make sure that they understand that. So if you know, after this, you're looking, go to Direxion.com, and we have a education insights section and a leverage and inverse education center where a lot of videos, overview literature. So yeah, definitely check that out. But let's dive into some of the stuff that you're looking at, Gianni.
Oh yeah, that's on slide 15. If we can go ahead a few slides. Let me see. There we go. Yeah, that's the that has all the links that viewers would need to learn more about what Eliott just explained. And then there's some standardized performance numbers. I don't know if you want to touch on those real quick.
We don't need to go into those. Okay. That's another great compliance thing in the if you want to, definitely check them out on this slide deck for the viewers, and it's all available on our website.
Okay, great. Well, then I can get into my analysis. Let's go ahead and jump over to slide 20, and we're going to start talking about semiconductors. So, as we briefly discussed the technology sector, we're now moving into a world, an economic environment where chips, semiconductors are becoming even more and more important. So I do a lot of ratio work and comparisons and outperformance, and believe it or not, semiconductors have outperformed tech. I mean, that's really not that big of a surprise if you understand that NVIDIA's in the semiconductor space. What I want to elaborate on is that this semiconductor index, the New York Stock Exchange Semiconductor Index, Direxion has a couple leveraged triple longs, triple shorts on that space. So if you want to take even more concentrated bets on what's going on in the broader tech space, chips are a great way to do so. And I want you to consider this really important factor. Pretty much every technology company out there needs chips or semiconductors as an input for their business. Even more so, those companies that are getting into the AI realm. Okay, so Microsoft, Apple, Tesla, Google, anyone that's doing artificial intelligence, and even the smaller companies out there, they need to basically redo all their chips. So this is creating a great demand for semiconductors. And I have the index here. This is a long-term chart, and I'm just sharing this again with respect to the idea that the trend is your friend. This is a longer-term bull chart, and you can see that the not only the magnitude of moves are generally favoring the upside, but the duration of moves. Basically since October of 2022, you've more than doubled. At the semiconductor index has more than doubled. Now, when you look at all these potential swing opportunities that you have here, you have rallies lasting several weeks at a time, and then the retracements are lasting significantly less time. So again, you don't want to be holding these triple leverage products for weeks at a time, but I'm sharing that with you for the idea generation component of which side of the market do you want to be on. And it's generally in the direction of the underlying trend. Now, of course, 2022, you would have been better off, shorting chips and being on the bear side of the market. But let's go ahead and take a look at what these funds look like. So we have SOXL, which is a triple leveraged semiconductor bull fund. And you can see here that it's kind of tracked that semiconductor index, higher highs and higher lows. And I think it really helps to have at least some sort of foundation of technical analysis in your repertoire. Can we go to the next slide, please, to look at SOXL? Yeah, there we go. So as you can see, there are certain price patterns that unfold in bull trends that generally give a trader an idea that the trend may continue. And one example of that is called an ascending triangle formation. We see this on the chart right here. The ascending triangle is frequently characterized by an upper horizontal trend line acting as resistance and an upward sloping trend line that leads to a compression of the trading range. Now, and that's so important because a lot of times you'll see big price moves unfold and then a subsequent period where the trading range of a fund or a market gets narrower. And that's the beauty of these products. So, when you are getting the upswing in chips, for example, you want SOXL, right? You're going to get the 3-time magnified long. But once the move gets extended, once you start to hit your price projections that you have as obtained from these price patterns, because believe it or not, price patterns can help you get, price targets on potential moves, right? Technical analysis is not an exact science, it's very much an art, but there are ways to deduce price targets. And I would, focus on the indexes that these, funds follow for those types of things. But, you can still see these price patterns unfolding on these leveraged fund charts. And so what we had here in SOXL, you had an initial breakout above resistance, which again, as I mentioned, is that upper horizontal trend line. You broke out above it, and whenever resistance breaks in technical analysis, it becomes support. And so we're seeing that retest now. You're seeing prices come back to retest that former resistance zone, turning support. And we talk about trends. Let's define trends. What is an uptrend? Well, an uptrend is defined by a series of higher highs and higher lows. A downtrend is defined by a series of lower lows and lower highs. So you can see on this chart, SOXL, each subsequent high is generally higher than the previous high, and each subsequent low is generally higher than the previous low. And so now the big test, I think, for the bullish case in semiconductors from a technical standpoint is, can we form another higher low? If so, it will reinforce the existing uptrend and kind of give you a sort of technical inclination that SOXL is the fund that you want to be in. If we can go to the next slide, because at the end of the day, technical analysis is all about risk management. We have to have a contingency plan to understand and to recognize, hey, we are incorrect and we need to bail on these positions. Whenever you're trading with leverage, you cannot afford to stay wrong for long, okay? And even though these reset on a daily basis, the last thing you want to do is get caught holding the bag on the wrong side of this market for days at a time. Now, can you swing trade and hold these for a couple days at a time? Sure. But personally, whenever I trade these, it's very rare that I hold them for more than, 3 to 5 days at a time. And those are, really instances when you have support or resistance and you're kind of having a capitulation of the sort from one end of the market in favor of the other. So, we kind of addressed the bullish case for semiconductors, but let's talk about a potential bearish case from a technical standpoint. We can't rule out that a falling wedge is present on this bearish semiconductor chart here. And we would have confirmation basically if we start to aggressively close above that upper trend line of the wedge formation. And you can see again here, the theme is the compression of volatility. You have a downward sloping upper trend line, a downward sloping lower trend line, and the trading range gets narrower and narrower. So I think another big move in semiconductors is coming. And if we're going to see a continuation of the trend, it's going to be to the upside. But if we are getting that, let's call it a summer high in stocks, there might be some short opportunities in chips. And it would probably, coincide with the sell-off in NVIDIA. But we're going to look at NVIDIA's chart in a little bit and see if that's going to be the case. So let's go on to the next slide and take a look at biotech. Biotech is a really interesting sector because it makes up, it falls under the umbrella of healthcare. And here we are talking about how technology is the biggest and most important sector in the S&P 500. And there's a lot of truth to that, no doubt. But you want to know what the second biggest sector in the S&P 500 is? It's healthcare. Now, is healthcare big enough to absorb all of the outflows from tech if it were to correct? Probably not, but it can take a lot of it for sure. And I would almost argue that from a participation standpoint, Eliott mentioned how, you're kind of seeing a narrowing of the leadership with respect to equities. If we start to see healthcare and by extension, biotech make a comeback, well, then we could see participation broaden and this rally in stocks could very easily continue into Q3. Because believe it or not, Q3 starts next week. I don't know where this year's gone, but here we are.
I know.
So, yeah, take a look at this biotech index here, because this is what Direxion's triple leveraged bull and bear biotech funds track. You'll see here that the S&P Biotechnology Select Index has not made a new all-time high since 2021. So Are we going to see a continuation of the bear trend, or is this an opportunity brewing? Are we going to play catch up in biotech? If biotech catches up, that could be good for the NASDAQ, could be good for the S&P 500. I may or may not have gone through all 30 stocks in the Dow Jones over the weekend and found that the two most bullish setups were Amgen and Merck, which are falling under the broader healthcare umbrella. So keep an eye on the biotech sector. I think there's going to be a lot of opportunities coming in the coming weeks and months. So let's talk about, what it looks like on the next slide. Oh, it's actually 2X. I call them LABU and LABD, but it's LABU and LABD. Those are the, you know what?
They are 3X.
They are 3X?
Yeah, they're 3X funds.
Okay. Yeah, I just realized that we have the, it's actually the gold charts, but that's okay. Let's stick on this biotech chart, because let's stay on this slide right here that we're on, because what I see happening here is a potential rounding bottom formation. And you can see that we kind of tested that resistance zone earlier this year. We were rejected by it. And obviously it doesn't take an astute chart observer to realize that there's been more opportunity on the downside through LABD instead of LABU. But keep a close eye on this biotech select index here. And you clear that $8,000 level, I think LABU is going to have a lot of potential opportunities on the long side. And let's also talk about what's happening at a fundamental level in the biotech sector. You have all these weight loss drugs that are coming out now. They're huge. You have all of these new RNA, vaccination technologies that are coming out, new cancer treatments, and just so many advances happening in that space. And it feels like there's kind of been a lull. The sector is still kind of figuring it out after the whole COVID debacle, right? It was an initial boom. And then, I don't know if anyone's been following it, but a lot of healthcare systems have some serious, financial problems. But innovation is usually the way out of a turbulent economic period. I like to say that, depression is the mother of invention, and necessity is the father. We do have some medical needs in this country. And I think that biotech will eventually come around and offer those solutions. So that's my take on the sector. I think it could be a big theme going into the back half of this year, especially in Q3, with a lot of potential, for upside.
Yeah, and I was going to say definitely an interesting space. Like you mentioned, the weight loss drugs have been kind of top of mind and kind of leading the biotech space. And biotech tends to be, was hurt, I'm going to say, broader. The, industry is definitely being smaller companies, and definitely very sensitive to, rate hikes, with high cash burn ratios. Definitely something, like you mentioned, potential catalysts, going into the second half of the year, definitely rate sensitive as well. So, if we see some indication of, rate, a reduction in rates coming, that could be an additional catalyst, definitely to small caps in general, but also especially the biotech space.
We leave the back half of this year. So
sorry, I think I lost you there for a second. Yep, can hear you now.
Okay, great. Yeah, I was saying it's biotech's probably my favorite sector going into the back half of this year. So okay, let's jump ahead 2 slides to the gold miner index, because I want to talk about gold and what's happening. One more slide. There we go. Yep. So we have the New York Stock Exchange ARCA Gold Miner Index, and what's been really interesting in the gold, as gold and silver as an asset class, is you had gold making a new all-time high this year. Silver has not, but we're talking about the miner specifically, and it's been kind of a rough environment over the last decade or so for precious metal miners. But if you look at their cash flow and their fundamentals, they've really cleaned up their books quite a bit. And obviously gold and miners have a major macroeconomic role as well. Gold's kind of like an alternative currency of the sort, sensitive to geopolitical and monetary conflicts and whatnot. But I really like what's happening in the mining space, because we've actually seen a lot more improvement comparing the mining sector to the spot price of gold. And one of the trademarks of a true bull market in the precious metal space is seeing mining stocks outperform gold. So here we have another saucer / rounding bottom formation on the mining index. And again, I think that if you clear that high from earlier this year in the mining index, you could really see some upside acceleration. If we go to the next slide, in NUGT, which is the bull 2x mining shares. And a couple interesting technical observations here. You can see how we've come back down and retested former resistance, turn support in that $34.50, $36 area where I have those green lines, those green horizontal lines. But we've also kind of coiled into a symmetrical triangle formation, another continuation pattern of the sorts. And here too, you can see the trading range getting narrower and narrower. So to constitute a breakout here, you need to clear that upper horizontal trend line. If you start to instead break below support, below that $34, $36 area, it could get a little nasty. And if we go and look at the inverse dust, I think that would be the better trade in that scenario. And you would see a rebound there. But, historically, you saw situations where when the Fed would lower rates, the opportunity cost to own precious metals would come down, because you have to understand the only way to get income investing in metals is to get dividends from mining stocks. But even dividends, dividend paying stocks kind of react on their own to shifts in monetary policy. So unless that changes that traditional correlation, I think that if the Fed does really cut rates this year, that it could be a boon for mining stocks, and you could really see them assume some leadership.
Yeah. I was just going to say, we've seen, like you mentioned, gold hitting all-time high, in May a couple times this year. And the miners have definitely, they initially lagged the price of gold. Of course, as you mentioned, these are gold mining stocks, not gold, but they are significantly influenced by the price of gold. So, we've seen a lot of, geopolitical catalysts in gold, and, we've seen the mining stocks follow. So it's been an interesting space. Great short-term trading tools. The miners, those are some of our traders' favorites to be trading short term.
I would also mention, just from a purely technical standpoint, is that if silver starts to take out its high from earlier this year, we have seen silver lag gold from a performance standpoint by a wide margin. Silver's I think it's at its highest. Well, it just recently rallied to its highest level since like 2013, but nowhere near its all-time high. And I'm not saying silver is going to go back to its all-time high, but what I'm saying is if you start to see silver outperform gold, I think that could translate into some technical strength for the mining space as well. So that's another thing to keep an eye on. Okay, let's go ahead to the next slide and start looking at some of these individual stocks. These are the market-moving stocks, right? They make up a huge percentage of the S&P, of the NASDAQ 100, tremendous market caps. And again, if you don't want to trade options or trade on margin, you have the opportunities to take leveraged upside bets in these types of names and even short them through these funds. So let's talk about Apple. I like Apple. I think it is poised to assume a greater leadership role in this rally because honestly, I'd like
Not sure if Johnny was lost or if I'm lost here. Oh.
Hey, yeah, Eliott. It looks like it was Gianni that cut out. He probably will be coming back shortly. If
Got
you
it.
wanna, I don't know.
Yeah, no, absolutely.
Yeah.
No, happy to. We'll wait for him to pop back in, but from more of just these products and just a little bit more background, as he was mentioning. He's back. Gotta
Sorry
love
about that. I'm not
gotta
sure.
love a quick internet disruption.
Yes, it's actually, we have pretty bad thunderstorms here in Michigan today, so that's probably why. But anyways, you want to finish your thought, and I'll continue with the Apple.
Oh yeah, no, I was just gonna say the use case for these, they're great trading tools, and something I mentioned earlier, not specific to these, but leverage and inverse in general, is the single inverse, single stock products like this, in this case, AAPD. Another great way, especially around earnings. If you have a concentrated position in, say, Apple, Microsoft, Nvidia, Tesla, whatever it is of, the Magnificent Seven that we have, and those are some favorite stocks to have as longer term investments. If there's concern around earnings or kind of a short term pullback, again, instead of realizing long term or even short term capital gains in a stock position you have in one of these, the single inverse is a great way to hedge that over a short to intermediate term period. With the single inverse, you get you still have the daily rebalance, but because you don't have leverage, you don't get quite the drift. So those are the single inverse is used a little bit more as an intermediate term hedge, as opposed to the 2x and 3x. It's more shorter term trading tools. But
yeah, so when it comes to Apple, I'm still bullish. I think we're going to see more upside. You could even make a strong argument that we established a flag pull with this breakout from the broadening wedge formation. This wedge formation, I categorize it into a momentum pattern. And the reason being is that when you break out from these patterns, it typically leads to an acceleration in upside momentum. And lo and behold, we did do that. Apple rallied over, I think it was like 10, 12% in a matter of 2 days. For a company of this size and magnitude, that is huge. So what we want to see from a technical standpoint now is for Apple to kind of digest and consolidate its gains, form a little pattern of the sort here, maybe a bull flag, and eventually potentially make its way up into the $250 area. So I think that if you are going to trade this with leverage, you might be better off focusing on the long side. If we can go to Amazon on the next slide. Amazon, I think, is very ripe for a breakout. We saw what happened with Nvidia recently. We saw what happened with Apple recently. We saw what happened with Microsoft recently. All those stocks hitting new highs. And I think what's happening here in Amazon is going to be something similar. In fact, the technical formation we see here, another ascending triangle formation, continuation pattern. What type of trend do we see? Well, it's an uptrend. We see higher highs and higher lows. Prices are already pressing up against resistance. You start to close at a new high here. I would look for Amazon to rally potentially as high as 220, 230 at least. So this could be, this is actually something I'm looking at personally on the long side in the coming days is Amazon breaking out and rallying to a new all-time high. And the ramifications for this are pretty profound as well. A major component of the consumer discretionary sector, there's been some concerns about the health of the consumer with inflation and high debt levels. Well, if a stock like Amazon is poised to break out, I think that actually bodes well for the state of the consumer with respect to the market's perception of how things are going. So I don't know if you have any additional commentary on Amazon, but I like it, Eliott.
No, I did too. Yeah, no, it's been one that has not been as high profile this year. Of course, yeah. I know you'll talk about it a little bit. Nvidia has kind of stolen the thunder from a lot of companies, even though there's some the Magnificent Seven, maybe with the exception of Tesla this year, have all been putting out great earnings, and there's a lot of strong catalysts coming from them.
All right, let's take a look at Alphabet on the next slide. Formerly known as Google. I still call it Google. It's like X. I call it Twitter. I'm probably never going to stop doing that. But in any event, Google or Alphabet, another bullish setup here. It's rising within an ascending channel. I have to admit, I don't think this is really the best type of price pattern to be aggressively trading on leverage. These are kind of steady Eddie patterns, I call them. They're continuation patterns, but it's one of those things where as long as prices within the channel you usually see a slow and steady rally higher, and not really the type of environment to be trading on leverage. With leverage, you kind of want to see wider price moves, more explosions to the upside and downside, and higher momentum. And we're definitely in a bull trend here, but I don't think it's really the best environment for it to be trading on momentum. So that's my quick and easy take on Alphabet, unless you had anything else to add.
No, I think you summed it up well.
Okay, let's look at Meta on the next one. I must admit, this one looks a little bit more vulnerable compared to some of its peers. Here you also see an ascending price channel, but I'm not really a fan of that gap down that we had back in April. Now, granted, we did fill that gap, and that usually means that some of the downside momentum woes can be quelled. But I'll tell you what, guys, if you start to take out that lower trend line in that 470, 480 area, you might have some trouble here in Meta, and METD may provide you a unique opportunity to capitalize on some downside in Meta. So this is probably not, it's definitely not in my top three, but not my least favorite either. I'm kind of neutral here, but unless you start to make a new high, it's basically new all-time highs or bust for Meta, and I think we need to seriously prepare for potential downside risk in this one as well.
Yeah, and this is our most recently launched single stock in the suite. So we launched that June 5th. So it's got a shorter track record, most of them being out for over a year. But yeah, this is the completion of our full lineup of the Magnificent Seven. So we've seen pickup in trading activity since the launch. It's under a month old.
Excellent. All right, let's go on to the next slide, because I think you'll understand why I'm so bullish on Amazon right now, because it's almost an identical setup that we had here in Microsoft that resolved to the upside, like we're seeing now in Amazon. So once again, uptrend observed, ascending triangle, you break resistance, you rally to new highs. I'm bullish Microsoft, and I think Amazon is going to follow that as well. So I think it's as simple as that for Microsoft. Okay, let's go on to NVIDIA, the next one. So this one's a bit extended. Obviously, what do we see here again? An uptrend, ascending triangle, a break above resistance, and a massive acceleration to the upside. So this is a really nice looking chart for the bulls. But here too, you're starting to rally within that ascending price channel. And after a big move like we've seen in NVIDIA, the healthiest thing it can do from a technical standpoint is slow down. Just because you rallied to new highs doesn't mean you need to start a bear market and crash. On the contrary, most of the time, stocks in strong bull trends will correct through time instead of price. And that's a good thing. So that being said, I don't think there's going to be a lot of directional swings in NVIDIA, major ones, I should say, over the next couple of weeks and months. And if we still want stocks to go up, that's what we want to see. We want to see NVIDIA take a pause and catch its breath here. So that's all I had to share about NVIDIA. I'm ready to talk about Tesla on the next slide too. All right, so this is the big laggard in the Magnificent Seven. Tesla also has not made a new high, I think, since 2021. But we do have some kind of a 50-50 technical setup here. I would call it a mixed trend, because you go back to the end of last year, you're definitely seeing lower lows and lower highs. You formed a bottom here back in April. You rallied back up. But what did we do here in June? We created what potentially could be a higher low, which is the first step in the establishment of an uptrend. However, we're not there yet. What I would want to see for confirmation of a bull trend is for prices to take out these highs from February. If we do, chances are you're breaking out from this rounding bottom, and Tesla could really start to participate to the upside, and you could see a rally up to the 260 area. That's the price projection from this rounding bottom, and effectively that takes you back to last year's highs. So this is not something that you want to buy today, but I definitely think what you want to keep an eye on for is this $190, $200 resistance level in Tesla. If it starts to clear that to the upside, I think TSLL, the double, the 2x leverage to the upside Direxion fund, I think will have some really nice potential opportunities.
Yeah, and mentioning earlier the treasuries, and we saw the contrarians as our largest inflows across our suite on something that has trended down throughout the year. That's the same case with Tesla, our 2x bull fund TSLL. That's the second largest inflows year to date, across, again, our entire suite of funds. So we're seeing a lot of contrarians kind of looking for some short-term bounces and for kind of Tesla to kind of turn it around. There's, of course, been a lot of news around the pay package with Elon and some other things going on, and just a tough space for the EVs right now. But we'll see if they can turn that around.
Great, and those are all the charts that I had to talk about today, Eliott. So I did have one last slide just for some key takeaways for traders. Remember, leverage can be very rewarding and very cruel. You do not want to stay wrong for long, not just in leveraged ETFs, but any market for that matter. In the business of trading and investing, your capital is your inventory. You run out of capital, you're out of business. So you also need to know your time horizon, how often you want to be in a trade, and kind of a stop loss when it comes to how long you're willing to be wrong as well, because you have to factor opportunity cost. If a trade is not working for you, then you are losing out on another potential trade that could be working for you. And so again, with these leveraged ETFs, you're probably going to know pretty quick if you're not on the right side of the market. And generally speaking, if the market's not doing what you think it should be doing, it's doing the opposite. So you need to adjust accordingly. Position sizing, whether you're hedging or speculating, know how much you're willing to risk. And you shouldn't be looking for a golden ticket trade is what I call. If one trade should not make or break you. And generally, if I'm going to take on a trade, I'm risking $1 to make $3. If I can't make at least $3 to, while risking $1, I won't take the trade. And, those are kind of the last takeaways that I wanted to cover. If you want to stay connected, you can link up with me on Twitter at Gianni_Depoce. I don't know if we have time for questions because we did come up on the hour, but Eliott, thanks very much for doing this to me. It was a real pleasure.
Yeah, no, thank you again. This has been great. And I think what you just summed up here at the end has been amazing. And, definitely, like you mentioned, stay nimble. Again, going back to our educational content, if you have any additional questions, you want to get a little bit deeper into understanding these leverage inverse ETFs, definitely go to Direxion.com on our website, education insights section. And you'll find a lot of great content there of just, how to trade these and how they work. But I appreciate you having me on today. It's been a great conversation.
Awesome. Well, pleasure as always, and we'll do this again.
Looking forward to it.
All right.